Welcome to the deep dive. Today we're exploring, well, a fascinating convergence. Two immense forces rapidly redefining global finance and business.
Hmm.
We're talking about the meteoric rise of private credit and the transformative power of artificial intelligence,
Right.
especially where they intersect and reshape the real estate sector. Okay, let's unpack this.
And what's fascinating here is how these domains, they seem distinct, right? But they're not just evolving side by side.
No.
No, they're actively creating entirely new landscapes.
Mm-hmm.
Opportunity, yes, but risk, too. Our mission today is really to cut through the noise.
Yeah, there's a lot of noise.
Exactly. We want to pull out the crucial insights from, well, all sorts of sources you've gathered. Market outlooks from Paul, Weiss, articles from Forbes, Deloitte.
Even Reddit discussions, David J. Moore's resource collection.
All of it. We're here to help you really grasp the profound, sometimes surprising implications of these trends.
Absolutely. And we're going to guide you through this. It's a complex terrain. First, we'll get into the incredible, almost explosive growth of private credit. We'll look at its surprising new partnerships with banks, insurers, and the innovative ways it's tackling financial challenges.
Oh, man.
Then we'll pivot. Sharp turn to AI's impact in real estate, how it's changing property marketing, speeding up loans.
Everything.
Right. And finally, we have to talk about regulation. The critical global efforts shaping up to govern AI, for fairness and stability.
Precisely. And you should expect more than just facts today. We're aiming for those aha moments.
Yes, definitely.
Connecting the dots so you don't just know what's happening, but why these shifts are, frankly, essential knowledge for anyone watching finance and property. Let's get started.
Let's dive right in. Private credit. It's become this, colossal new force in finance.
It really has.
It's not just some fast-growing alternative asset class anymore. It's fundamentally redrawing the map. It's become a vital source of capital.
Especially as banks pulled back a bit.
Exactly. Banks retreating from middle market lending, regulations tightening, public markets being, volatile.
And private credit steps in.
All right, with this broad range of tailored financial products really fitting specific needs.
And fast-growing, honestly, that's putting it mildly. What's truly striking is just the sheer scale of this expansion.
How big are we talking?
We're looking at a market that's ballooned nearly tenfold. It hit $1.5 trillion in 2024.
$1.5 trillion.
And the forecasts. Some predict it could surge to US $3.5 trillion by 2028.
Wow.
Just think, over the last decade, 13 private credit funds have closed deals at or above $10 billion.
So it's not just growing, it's forcing others to adapt.
Absolutely. Traditional players have to react. It's creating this, less visible sometimes, but hugely impactful financial system. Too big to ignore now.
3.5 trillion by 2028. That's an incredible projection. What's really driving that aggressive growth? Are there potential headwinds, things that could slow it down or challenge its stability?
Well, it's largely driven by that demand, right? For tailored, flexible capital that banks maybe are less able to provide now. Plus, investors really want those higher yields.
Makes sense.
Now, $1.5 trillion, it's still smaller than, say, the U.S. bank loan market at $5.4 trillion, or investment-grade bonds at $8.1 trillion.
Right.
But it's already comparable to high-yield bonds, leveraged loans, both around $1.4 trillion, and there's definitely room to grow. Europe, especially, shows strong potential.
And you mentioned AUM, assets under management.
Yeah, if you visualize the AUM for private credit, it's just this steady upward climb since 2006. And a big chunk of that is what we call dry powder.
Capital waiting to be deployed.
Exactly. And there's real pressure on these funds to put that money to work. That pressure means they're actively hunting for opportunities, and that reshapes everything: who lends, who borrows, how capital flows globally.
So this huge pool of capital, this dry powder, it's not just sitting there, it's driving change, reshaping relationships, especially between private credit and traditional banks.
Precisely.
It used to feel like rivalry. Now it's more like partnership.
That's the fascinating shift. Even though banks are reshaping their balance sheets, tighter regulations and all, they're still essential. But instead of just competing, banks are actively partnering with private credit lenders. They're providing financing, distributing the products, leveraging private credit's know-how in origination and risk management.
Interesting.
It also reflects the economy now, right? Higher interest rates stress lower quality credits, but they actually benefit high-quality fixed-rate assets.
Oh, okay.
So security selection and really deep credit underwriting become absolutely key. If we connect this to the bigger picture, banks see that private credit can reach markets offer solutions that their own rules make tricky. They can offload some risk, some capital requirements.
It definitely sounds like a win-win, mutually beneficial. But are there still tensions, areas where maybe their long-term interests don't quite align?
That's a perceptive question. I mean, sure, there are always potential tensions around fees, control, maybe reputation.
Okay.
But the benefits often seem to outweigh those. Banks tap into their existing origination channels, keep customer relationships, and access higher return markets efficiently.
And private credit gets the deal flow.
Exactly. They get access to deals to deploy that dry powder we talked about. And we're also seeing credit funds get clever, rivaling bank cost of funds, often by using captive insurance vehicles. Which actually brings us neatly to the next point.
And the real-world examples are just everywhere now, aren't they? Ares Management buying AMP Capital's infrastructure debt platform.
Apollo setting up Atlas SP Partners.
KKR acquiring that huge, like, $7.2 billion RV loan portfolio from Bank of Montreal.
And the big banks, Goldman Sachs, JP Morgan, they're diving deeper. Goldman's building a new unit. JP Morgan's earmarking another $50 billion for direct lending.
It's across the board. AGL Credit Management with Barclays, Mizuho with Golub Capital. It feels like a permanent shift.
It does. And this raises an important question. With all this integration, are we just shuffling risk around the system? Or are we actually making it more diversified, maybe more resilient?
What you do?
Probably a bit of both, but leaning towards more diversified, I'd say.
Looking ahead, these partnerships are only going to deepen.
Sources are predicting jointly marketed platforms, joint ventures. They could dominate the market in 2025.
So structuring these deals must be key.
Absolutely. They're thinking intensely about the scope leveraged loans, investment-grade infrastructure, asset-backed loans, who puts up the capital, the scale, fees, decision-making. It's all about creating bespoke solutions for a market that's constantly changing. It points to a more integrated, yes, but also more complex financial world.
Okay, so beyond banks, there's another big player getting involved, insurers.
A crucial one.
And it seems private credit fits their needs perfectly. Insurers, like banks, want to optimize return on capital, and private credit's longer-term profile matches their long-term liabilities. It's a natural fit.
It really is a powerful synergy. Historically, insurers invested through things like separately managed accounts, or maybe deal-by-deal structured investments, especially in long-duration assets like commercial real estate.
But that's changing, too.
We're seeing more platform structures now designed for multiple insurers. And the next big growth area, expected to be these bank-insurer joint venture-style partnerships.
How would that work?
Basically, insurers provide the capital, banks find the opportunities, handle the deals, and there's huge demand. Yield-hungry U.S. life insurer accounts are really driving demand for asset-based financing, infrastructure finance.
Any examples?
Oh, yeah. Blackstone Credit and Insurance had one of its busiest quarters ever recently. They invested or committed $21 billion globally direct lending, infrastructure, asset-based credit. Shows you the scale.
$21 billion in a quarter. And a key vehicle for insurers here is something called rated note feeder funds. What's the appeal, and are there risks?
Okay, think of these rated note feeder funds almost like a layered cake, financially speaking.
Okay.
They issue different slices or tranches of debt. The bottom layer is subordinated debt. Equity, they act as a cushion. They absorb the first losses if anything goes wrong.
So the top layers are safer.
Exactly. That makes the higher priority slices, the senior notes, much safer for investors like insurers. It enhances the credit worthiness compared to just holding the underlying loans directly.
And they're flexible.
Very flexible. The terms, the structure, they can adapt to the main fund strategy, meet rating agency rules, and fit specific investor needs, capital charges, accounting, tax, all that.
But with fast innovation.
Comes scrutiny.
That's
And yes, these popular rated note feeder funds, they are definitely on the regulator's radar now.
So what does that scrutiny actually look like in practice?
Well, the National Association of Insurance Commissioners, the NAIC, they're taking a much closer look at how these are treated for capital purposes. Meaning regulators are catching up. These NAIC changes, they're a significant de-risking move for insurers. More scrutiny, yes, but aiming for greater stability in this rapidly growing complex area.
Specific changes.
Yep. January 4th, 2025, stricter standards kick in for bond treatment of these rated notes. It involves a deeper look at the underlying cash flows. Then, from January 1st, 2026, the NAIC's Securities Valuation Office gets power to review and challenge the filing exempt status some notes have.
How are fund managers reacting?
They're getting ahead of it, engaging investment banks, doing more thorough diligence, preparing much more robust documents for these rated notes.
So for you listening, what's the takeaway?
The takeaway here is a real push for more transparency and reduced risk in a key part of the market. But it could potentially influence how much capital is available and at what cost.
Right, a tightening of the reins. Makes sense given the scale.
Yeah.
Okay, let's shift gears a bit, move to a more complex but definitely prevalent side of private credit, liability management, especially in stressed or distressed situations.
Yeah, this gets complicated.
We've seen a sharp increase in these deals lately. Companies facing trouble, looking for relief.
Usually financial covenant relief, maybe more liquidity.
Right, like PI interest payment in kind, using more debt to pay interest instead of cash.
Or maturity extensions, maybe debt discounts.
And the tools used can be pretty controversial.
They can be. Often, the key is the issuer threatening to incur, or actually incurring, what's called priming debt.
Priming debt.
Yeah, debt that's structurally senior or somehow advantaged over existing debt. It gives them leverage to get relief.
How do they do that?
Transaction strategies include things like priming debt exchanges, issuing new senior debt, often using exit consents to strip protections from existing lenders who don't participate,
Ouch.
or covenant stripping, guarantee and collateral stripping, releasing collateral to push creditors to play ball.
And specific structures.
Two common ones are up-tier transactions. The company and some lenders amend existing debt docs to issue new senior priming debt and drop-down transactions.
Drop down.
Company moves assets to an unrestricted subsidiary or a non-guarantor subsidiary, then issues new debt secured by those assets outside the reach of the original lenders.
And the catch.
The crucial point is these asset transfers are often allowed under the original loan terms without needing lender consent. Gives issuers huge negotiating power.
That really highlights vulnerabilities for investors if they're not incredibly careful. We've heard about LME blockers, Chewy blockers, J.Crew, CERTA blockers, things investors thought protected them.
Right, supposed protections.
But PitchBook's 2023 report pointed out they often have serious flaws. It's like buying a house and finding out the seller can just take back the kitchen later.
Huh, yeah, I can feel like that.
The report said these blockers can actually be amended away by a majority of lenders. Leave some investors high and dry.
It really does. The critical insight from all these complex LMEs, these liability management exercises, is stark for lenders.
Yeah.
Even seemingly solid covenants can be engineered around. Diligent legal review, active monitoring, absolutely non-negotiable.
So what's the trend here? What do we expect going forward?
Well, expect continued drop-down transactions, because that covenant flexibility is often built into the documents. It might be used to facilitate sponsor investment or just as leverage.
And in club deals, where it's a smaller group of lenders.
In true club deals, maybe more likely amendments, reset covenants, PIK interest, extend maturities, but usually in return for tightening up the documents elsewhere.
What about bankruptcy?
If a turnaround fails, you might see a consensual handover of equity more often than a formal bankruptcy, unless there's a real need for operational restructuring. But as private credit deals get more widely held, maybe even traded, we could see these non-pro rata, less than fair to everyone transactions spread. Increases complexity.
So for you, the listener,
Understanding these shifting power dynamics and distress is vital, highlights the need for vigilance, sophisticated advice.
a profound point. Okay, let's
Yeah.
pivot now. From the complexities of private credit to something equally transformative, AI's revolution in real estate.
A big shift.
Drawing on various sources, including David J. Moore's curation, it's just clear AI is a game changer across the whole sector. We saw Reddit users saying it drives way more engagement and less time wasted on dead leads.
Absolutely. And the applications are incredibly broad, hitting the entire real estate lifecycle. Lead generation, marketing. AI keeps conversations going, builds relationships, gives personalized property recommendations.
And generative AI.
That's creating compelling SEO-optimized property listings, enhancing virtual tours with 3D imaging and VR technology, makes exploring property way more immersive, more efficient.
That's a huge leap from just photos online. So beyond the marketing flash, where else is AI making a really deep, maybe disruptive impact, like in core operations? Loans, maybe.
Excellent question. Take AI-powered hard money loans, short-term loans, often for flipping properties.
Right.
AI is speeding up approvals. We're talking within days or weeks. Crucial in fast markets. It helps ensure efficient loan-to-value ratios, LTVs, typically 50–70%, and informs the best repayment terms, usually 1–3 years.
Who uses this?
Ideal for property flipping, land development, distressed properties, places where traditional loans might be tougher to get.
And there's software for this.
Yeah, like LendFoundry's hard money lending software. It uses AI-driven risk assessment models, analyzes borrower history, property trends, market conditions, integrates with over 90 third-party data providers.
Wow. What else?
Property management. AI simplifies processes,
Yeah.
rent collection, lease renewals, even predicting maintenance needs, cuts down manual work.
Predictive analytics.
Huge. AI processes vast data sets to forecast market shifts, housing demand, construction costs, helps optimize investment strategies.
It's incredible how comprehensive its reach is. Virtual tours, AR for visualizing changes.
Right. Reduces physical visits, legal documentation automation, extracting details, e-signatures, streamlining workflows.
Even tenant screening.
Yep. AI analyzes credit scores, rental histories, employment records, helps find reliable tenants. It's a full-spectrum transformation.
And academia is catching on, too. You mentioned Texas universities.
That's right. Baylor, Sam Houston State, Texas A&M, UT Austin. Many Texas universities are integrating AI into coursework, planning new colleges focused on AI, data science.
Preparing the next generation.
Exactly. As Dean Arnold Castro at Texas A&M said, AI is not eliminating jobs. It is elevating the skills required to remain competitive.
That academic embrace flows right into the next big topic.
Regulation. The critical need for it, yes. AI is developing so fast, its impact is so profound, the conversation had to shift.
From soft law to hard law.
Precisely. From voluntary guidelines, like the OECD AI principles, to enforceable regulations. Especially after generative AI went mainstream. Concerns about misinformation, discrimination, job displacement, they really spurred governments into action.
And we're seeing different approaches globally. The EU AI Act, adopted 2024.
That stands out, probably the most holistic horizontal regulation. It uses a hybrid approach.
How so?
It regulates AI systems based on application banning social scoring, strict rules for high-risk systems like medical devices or critical infrastructure.
Yeah.
But it also adds rules for general-purpose AI models, GPAI, things like documenting energy use, copyright policies.
And penalties.
Big ones. Up to 35 million euros, or 7% of global annual turnover. It shows they're serious.
How does the U.S. compare?
The U.S. AI Executive Order from 2023 focuses more on technology types like powerful frontier AI, and relies more on existing agency powers, less on brand new laws, more adaptive, maybe less prescriptive.
What about elsewhere? Canada, Brazil?
Both Canada's AI and Data Act, AI, and Brazil's AI bill emphasize risk-based obligations. They seem to be evolving towards hybrid approaches like the EU.
Differences.
Canada's data includes criminal offenses, administrative penalties. Brazil's bill is seen as comprehensive, lots of civil society input, both pre-market and post-market rules.
And
China's 2023 interim measures focus on generative AI services specifically. High requirements, both before release, pre-registration, and after monitoring. The clear message globally is governance is needed, even if the methods vary.
And it's not just broad AI laws. There are specific rules hitting real estate, particularly in the U.S.
Exactly. The new Consumer Financial Protection Bureau, the CFPB rule, effective 2025. It targets automated valuation models, AVMs, used in mortgage lending.
What does it require?
It mandates quality control, processes to ensure a high level of confidence in the estimates, protect against data manipulation, avoid conflicts of interest. It also requires random sample testing and reviews.
And critically.
Critically, it requires compliance with non-discrimination laws. And lenders are on the hook for ensuring compliance, even if they use third-party AVMs.
So for anyone using or encountering these AI evaluations,
It means a much bigger focus on accountability, fairness. It's about building trust in these automated systems, which brings us back to the broader challenges.
like data privacy.
Huge. Complying with GDPR, CCPA. Ethical issues, too. AI models can accidentally perpetuate biases in pricing or tenant screening if not carefully designed and monitored.
And legal challenges.
Liability?
Determining liability for AI decisions is still a developing area. All these evolving regulations are crucial for building trust, ensuring fairness, managing risk in this increasingly AI-driven economy. It affects you as a consumer, a professional, a business.
So what does this all mean? We've covered so much ground today. The incredible rise of private credit becoming this powerhouse.
It's new partnerships with banks, insurers.
Then that complex world of liability management, the strategies, the vulnerabilities.
Where our debt terms can be reshaped.
And then the huge leap of AI in real estate, revolutionizing everything from marketing to loans.
A true transformation.
But alongside all that innovation, the global sprint to regulate, to ensure fairness, stability.
Which leads us to a final thought, maybe a provocative question for you to mull over.
As private credit keeps broadening financial access, maybe democratizing it in some ways, and AI becomes this essential architect of real estate, How will this dual evolution ultimately redefine investment opportunity and market stability for individuals, for institutions in the years ahead?
What new forms of value might emerge? What existing structures might be really challenged?
Exactly. Things to think about.
A truly fascinating question to ponder indeed. Thank you for joining us on this deep dive into the, well, interconnected future of finance and property. We definitely encourage you to continue your own explorations into these captivating, fast-changing fields. Until next time.